Hello everyone, this is Paris. Welcome to Budgetholics. 2020 has been a crazy year, no matter where you live, no matter what your job is. Our lives have transformed into some sort of poorly written dystopian fanfiction, with most governments across the globe exemplifying their monumental inadequacy when it comes to managing a health crisis. If you've been a stock market investor, especially investing throughout March, your portfolio returns had at least a small consolation prize for 2020. I myself have achieved a 175% return on my investment portfolio, and in today's video I'm going to go over the 5 best performing stocks in my portfolio this year. To be clear, I've also done some investing in commodities and cryptocurrencies, but the commodities I sold off and I started consistently investing in cryptocurrencies in the mid-June, I think, of 2020, and they still take a relatively small percentage of my portfolio. Without further ado, let's go into my 5 best stocks of 2020, and for each company I'll explain why I started investing, the prices at which I started buying and if I sold off, and my thought process when investing on each and every one of those companies. If you're interested in personal finance, investing and wealth building, please hit the like and subscribe buttons, as this helps me immensely with the YouTube algorithm. Number 5 on the list is NIO. NIO is a Chinese EV company. Along with Li Autos and XPeng, it's one of the 3 largest Chinese EV producers. NIO is a company that had one of the largest IPOs of 2020, specifically on September 12th. Their IPO was underwritten by Morgan Stanley, JP Morgan and Goldman Sachs. Much like Tesla, they started with a supercar, the EP9 model in 2016. Other models include the EC6, the ES8 and the ES6. NIO is highly dependent on Chinese government policies and incentives. I first heard about the company from a friend. When somebody tells you about a company, the best thing to do is to research it yourself. That being said, you should never dismiss a tip or an advice. You just need to validate it. One of the most impressive things about NIO is that they are offering battery as a service. Normally when you buy a car, the battery is included, especially in the case of electric vehicles. However, NIO has filed 1,000 patents allowing its customers not to buy the battery with the car, but rather rent it in the future. This has many advantages. Firstly, not buying the battery will save you around $10,000. What they're doing instead of selling the battery is that they're renting a 70 kilowatt-hour battery for $142 per month. Apart from the obvious savings part, this has many advantages. For example, they can monitor how often customers need to change batteries, how often they need to charge them, and also they allow customers to get the newest battery in terms of technology and innovation, seemingly at no extra cost. In order to provide their battery as a service, they have a number of spots where NIO car owners can go and change their batteries. The problem with this strategy is that it requires a huge investment when selling their products in a specific region. In many regions, it's already extremely difficult to find an EV charger for your car. Finding a dedicated provider that will be able to change the batteries of your car is going to be even trickier. Of course, you can always buy NIO cars with the battery included, similarly to any other electric vehicles. Moving on to number 4, we have Palantir. 2020 has been a crazy year for IPOs, and October has been a very interesting month for data analytics companies. Namely Snowflake and Palantir, as both of these companies' IPOs took place in October. For many investors, there was a trade-off between the two. You would either invest in one and not the other. Palantir is an older company founded in 2003, whereas Snowflake was founded in 2012. The main difference between the two is that Snowflake has a larger customer base serving more corporate contracts, whereas Palantir is more into governments and intelligence services contracts. They are also very different in terms of valuation. Snowflake started trading at 120 times earnings for the financial year 2021, whereas Palantir was trading at 15 times the projected earnings for 2020. Given Palantir's close ties to intelligence services, it has given the company some bad rap. However, given their ties to intelligence and governments, it has been contracted by many additional European nations, granted sometimes in not such a transparent manner. Government contracts are typically more fixed, whereas corporations are much more flexible in switching their provider. That's why I think that the already established client base of Palantir will allow it to keep its steady revenue streams increasing, while simultaneously they'll be able to expand and gain more corporate clients. Number 3 on the list is Zoom. the most used video conference platform of 2020. I've used all four of the main platforms and I can see why Zoom was the most used platform in 2020. Although WebEx is a good platform, I don't think it's very user-friendly and I was not very impressed with the options and the services it offers. The problem with Microsoft Teams and Google Meets in corporations is that your company needs to be running either the Office 365 or the G Suite platforms accordingly. This is not a problem with Zoom, and this is why it was widely adopted in remote work, online education, and online meetups instances. I started buying Zoom at $165 per share and completely closed my position when the company reached $450 per share. My reasoning behind this is that firstly, the price was very high, trading at 137 times earnings. Furthermore, I was doubtful that Zoom could duplicate those returns in the future. My problem with Zoom is that it doesn't have a wider ecosystem that will allow it to retain its current customers and further increase its customer base. In this sense, I do think that Google Meets and Microsoft Teams will do better than Zoom in the coming years. That being said, I do believe that Zoom has still some growth potential for the next 5 or 10 years. Number 2 on the list is Apple, which yielded me a 240% return on my capital. This has been a great year for Apple investors. Everybody knew that they would come out with the new iPhone. However, the M1 chip was a great addition to their arsenal. I'm a big believer in Apple innovation, and more importantly, the management team has shown that their interests are aligned with the shareholders' interests. And I consistently bought Apple throughout the year. Apart from the iPhone, they have a strong services ecosystem such as Apple Music, Apple TV, Apple Fitness, and Apple News, which may constitute Apple a much better alternative, at least for iPhone users, than companies like Spotify and companies like Netflix if they manage to increase the content on their Apple TV service. A driver in Apple stock's price increase over the past month has been the leak that they will have a car ready for deployment by 2025. Also this year they came out with 3 computers using the M1 chip, and next year they're expected to come out with more computers. I believe that Apple will be one of the best, if not the best, growth stock for 2021. And in number 1 we have the largest manufacturer of sexy swords. Jokes aside, in terms of market cap, Tesla is larger than the next 5 auto manufacturers combined. That being said, it currently trades at a PE ratio of over 1200. To put things into perspective, the average PE ratio of the S&P 500 is 26.79. That means that for the average S&P 500 company, investors are willing to buy $1 worth of earnings today for $26.79, whereas in the case of Tesla, investors are willing to buy $1 worth of earnings today for $1,300. A joint venture between Tesla and The Boring Company, which is another company managed by Elon Musk, could completely transform the traveling industry in the United States. And over the past year, it has yielded an impressive 741% return. Tesla was my first stock purchase, and I started buying at the price of $336 per share. This was before the 1-to-5 August stock split, so in terms of post-stock split prices, I started buying Tesla shares at $67 per share. Today it's trading at $678 per share. A large reason of why the price is so high right now is Tesla's inclusion in the S&P 500. An index is a basket of companies, so when somebody is investing in an index, they're investing in the companies included in this index. And in the case of Tesla, this meant that everybody previously invested in the S&P 500 would need to purchase a small share of Tesla. Tesla has been the largest ever addition to the S&P 500 and is currently the 7th largest company in the index. It has a weight of 1.54%. My prediction is that Tesla's price will deflate sometime in 2021, and after that we'll see a more sustainable rate of growth for the company. That being said, I'll keep dollar cost averaging into Tesla. This was the list of my 5 best performing stocks of 2020. Let me know down in the comments what were your best investments and what you think 2021 holds for us investors. If you enjoyed the video, please hit the like and subscribe button. Also, if you enjoyed the video and you think people you know might enjoy it as well, please share it. Thank you very much and have a happy new year.